I just wanted to say, I wanted to say something to the bankers who are with us. Um, you know, we are all very comfortable when the Bank of Canada, the Federal Reserve, the European Central Bank, when there's a crisis like COVID, or when there was the credit crunch back in 0809, creates the kind of monetary policy that ensures liquidity, that financial markets, institutions have the money they need to manage. Um, During the credit crunch back in 0809, while the federal government did not bail out the banks in the normal course, what Central Mortgage and Housing did was buy a portfolio of perfectly good mortgages from the banks that were performing, they were excellent. So the banks could get $362 billion in cash for those mortgages, which they then had to have the liquidity they needed to deal with small business loans and car loans and making sure there's cash in the machine when you go with your card to get some, not because they were in any difficulty per se, but because credit had dried up around the world and getting liquidity was problematic. So what I think is really instructive from that is if we create we create liquidity as a global priority, for the big players, understandably, why aren't we creating liquidity for the people at the low end of the spectrum? Because they too have needs and they're part of our society and they deserve a seat at the family table. So I think we have some of that in the past to draw on. And the one thing I'd say about Michael Sabia, who's a great guy, by the way, bright and able, is that when he was the ADM in finance and created the GST back in the Mulrooney era, he also created the GST low income tax credit, which was automatic. I used to say to my graduate students, file your taxes. And they would say, well, we don't have any money. I said, that's exactly why you should file your taxes, because the federal government will automatically put money in your account. So the sales tax doesn't take too much of your income as it expands across the country. So there are some lessons in the past, and I'm grateful to both bankers for having dealt with some of those issues today.
Well, if I may, I would just build on that by saying what we've seen from the 2008 financial crisis and from the experience of the lockdowns this year is that creating abundant liquidity with low interest rates that makes it easy for businesses and households to borrow is a necessary condition to getting us through difficult times, but it's not sufficient, particularly now when we've seen households boost savings massively and cut back in some areas on spending, and business over the last decade in Canada has consistently not invested at the rates that most of us in the economic modeling world would have expected when borrowing is so cheap. We need to do more. We need to ensure that low-income people have money in their pockets to create consumer demand, and that creates the conditions that build confidence for businesses to invest in additional capacity, which then leads to jobs, which is essentially the virtuous circle that we like to talk about in economics. And that only happens when they see the demand for their goods and services and they see lower risk around undertaking that debt. And that's not just the case for businesses, but obviously it's the case for households too. There are, a variety of loan products that are available right now that households in trouble aren't taking because we're small businesses that are run by just a few people aren't taking because they don't know what things are going to look like 6 months or a year from now. So cheap money isn't a sufficient condition to sustain growth. It's a necessary condition in difficult times, but it needs to be complemented by things that take risk down, provide incentives for businesses to invest, and allow people, particularly low-income people, to spend. And that's where universal basic income can be an important part of the policy discussion to build on the remarks that Hugh just made.